If you've ever researched Chinese stocks, you've probably noticed that they're pretty cheap. There are a lot of metrics we could look at to establish this, but here's just a sampler. Alibaba, 9 times earnings. JD.com, 10.4 times earnings. PDD Holdings, that's the owner of Temu, 21 times earnings while growing at 90%. And there are examples in other sectors too. For example, in a market where Western banks usually trade at something like 9 to 12 times earnings, Chinese banks are usually trading at more like 3 to 5 times earnings. Basically, regardless of what sector you're looking at, there's always some kind of a discount that investors seem to be applying to Chinese equities. In this video, I'm going to try to find what's behind that. Now, before getting into what I personally think is behind the Chinese stock market discount, I should take a minute to review what others have said on the topic. This collection of news headlines can give you some indication as to what people are thinking. China's economy is slowing down. What gives? China's deflation, another tell of serious economic trouble. China's aging population threatens switch to new economic growth model. All of these theories of China's lackluster stock market performance have some plausibility on the surface, but when you look at them more closely, they start to fall apart. Missing GDP targets? Sure, but China's growth is generally quite high, even in years when it misses its targets. Deflation? Well, if it were sustained over a very long period of time, it could be a concern. However, Canada entered near deflation in 2020 with a 0.4% CPI growth rate. Its stock market did crash that year, but it recovered very quickly. So the explanations given for the China discount by the news media don't seem to make a whole lot of sense. And furthermore, if you've ever read news articles about Chinese stocks or a particular Chinese stock and read the comment sections, you'll see that these explanations given by the media aren't exactly what China bears are thinking either. Because in said comment sections, you will quickly notice the exact same comment coming up over and over and over again, albeit in slightly different words. China-Taiwan War, your shares are going to zero. The possibility of a conflict between China and Taiwan leading to US investors losing access to Chinese stocks is, I would submit to you, the real reason for the atmosphere of fear surrounding Chinese stocks, and that atmosphere of fear, in turn, is the real reason for the China discount. Now, if you aren't familiar with this narrative, let me just give you a quick rundown. The US and China are currently at odds with each other over the status of Taiwan, an island off China's coast. Formally, it has never declared independence, but the US considers it a vital security asset, an ally, because it is the home of much of the world's chip manufacturing. And so the problem is, China wants to reunite with Taiwan in some way, whereas the US wants Taiwan to remain independent and therefore easier to influence. And the thought is, if China ever were to invade Taiwan, the United States would quickly delist Chinese stocks, and then China, for its part, would block Americans and other foreigners' access to Chinese markets. Concerns about this are not total nonsense. Scenarios like the one just described have played out in the past. For example, at the start of the Russia-Ukraine war, Russia started making it very difficult for foreigners to access its markets, while the US delisted Russian ADRs, the end result being that a lot of ETFs of Russian stocks went to zero, and direct US holders of Russian stocks were sitting on shares they couldn't sell, and it was like they had zeroed. So, is China going to invade Taiwan? Well, that's the billion, maybe trillion-dollar question. China's official stance has always been that it seeks peaceful reunification with Taiwan through dialogue and discussion with Taiwanese leaders. It's not immediately clear what form of unification it wants, whether a EU-style monetary union would be sufficient, or whether it won't be content with fully annexing or absorbing Taiwan into its own territory. However, it has said that it aims to achieve its objectives peacefully. On an extreme long-term basis, we can't rule out the possibility of China invading Taiwan. In 10 years, 20 years, when China's military is much stronger than it is now, sure, it could happen. However, it's important to note that US military experts have actually written papers discussing their opinions on this matter, and these papers generally tend to argue that if China were to invade Taiwan, it would be sometime in 2026 or afterward, because, as is the official Pentagon position, China doesn't have the military capacity to successfully invade Taiwan right now. So while we can't rule out the possibility of a Taiwan War in the distant future, it is not likely that we're going to see one in the near future, and that's the official Pentagon position. Now, yes, it is quite likely that foreign holders of Chinese stocks will get into a lot of trouble if China invades Taiwan. The Russia case study shows us that what can happen is a country like the United States, for example, could delist any of that other country's stocks are listed on its exchanges, while the country in the opposite position, let's say China, could then block foreigners' access to its capital markets. In such a scenario, it is like your stocks have gone to zero, at least temporarily. However, we have to be sober-minded when we think about the probability of China invading Taiwan. China has said that it prefers peaceful reunification. U.S. military brass have said that if China does invade, it won't be for another several years. And finally, there are a lot of other geopolitical disincentives to China invading Taiwan. For example, the loss of trade relationships with the United States and probably European countries as well. Now, this doesn't mean that you should just run out and invest all of your money into Chinese tech stocks, thinking that they're going to rise to U.S. tech stock valuations overnight. The tail risk in the scenario where China does invade Taiwan and where the US and China both react by restricting access to Chinese stocks is extreme. However, you could deal with this basically through things like hedges and portfolio weightings. Maybe weighting Chinese stocks at a smaller weighting in your portfolio than US stocks is preferable to simply avoiding them altogether. Quite literally, there is risk in every single investment. Even US treasuries, which are so low risk that people refer to them as the risk-free rate of return, still expose investors to the risk of capital losses if they're not holding to maturity, and also can even deliver negative real returns when held to maturity because they sometimes don't yield as much as inflation. And in fact, treasury yields did lag behind inflation for most of the last 2 decades. It's only in the last year or two that their yields rose enough that investors are now seeing real returns on US treasuries. Does this mean that you can just feel comfortable running out and investing all of your money into Chinese stocks? No. These stocks are more volatile than average. They do expose you to certain tail risks, and like any other investment, they probably should be held in a diversified package. Now, does that mean you should avoid China altogether because of extreme tail risk in one highly unlikely scenario? Everybody has their own unique financial needs, but I'm inclined to think that for most, that's probably not the smartest move.